If you stay with me until the end of this video, you're going to walk away with something most investors never get. That's the ability to finally understand which type of fund actually builds your wealth instead of quietly draining it. And that single decision could be the difference between retiring comfortably or spending decades wondering why your investments never seem to grow as fast as everyone else's. Because here's what nobody tells you when you start investing. People throw around terms like ETFs, mutual funds, and index funds as if they were interchangeable, as if choosing one over the other is just a matter of preference, like picking between decaf or regular coffee. But the truth? Choosing the wrong one can silently cost you tens of thousands of dollars. Not overnight, not in a dramatic crash, but slowly, invisibly, the same way a tiny leak can hollow out an entire house before you even notice the cracks on the walls. And what drives me absolutely insane is how confident people think they are when making these decisions. They'll tell you, oh, I picked a mutual fund because my advisor recommended it, or my retirement plan automatically put me in one, so it must be good, or the classic ETFs, index funds, they're basically all the same, right? No, they're not. Mutual funds can charge fees so high they eat a chunk of your returns every single year. And the worst part? Most of them don't even beat the market they're trying to outperform. It's like hiring an expensive driver who swears he can get you to your destination faster, only to realize he's been circling the same block for a decade. Index funds, on the other hand, look simple, almost too simple. They don't try to beat the market. They don't try to predict anything. They just quietly mirror an index. And because they don't have a team gambling with your money behind the scenes, they cost practically nothing. They're like a reliable autopilot. Boring, steady, consistent, and yet, over the long run, astonishingly effective. And then you've got ETFs, the modern hybrids. They behave like index funds, but you can trade them like stocks. Real-time prices, low fees, different tax behaviors depending on where you live. They give you flexibility, diversification, and control, all in one wrapper. Which sounds perfect until you realize that the wrong kind of ETF can be just as damaging as a bad mutual fund. High fees, weird structures, leverage, complexity, hidden risks most beginners don't even know exist. So here's the twist almost nobody sees coming. The fund that feels the safest, the one your employer defaults you into, the one your advisor casually recommends, the one with the most polished brochure, could be the one quietly costing you the most money over the next 20, 30, 40 years. And yet the choice between ETFs, mutual funds, and index funds is not about which one is best. It's about which one is best for you, your goals, your timeline, and how much of your return you're willing to sacrifice to fees, taxes, or the illusion of expert management. By the time we finish this video, you'll know exactly how each fund really works behind the scenes, why they behave so differently, and how the fees and mechanics can make or break your returns. And most importantly, which one makes the most sense for your long-term strategy. Because once you understand the real differences, the investing world stops feeling like a confusing menu and starts feeling like a system you can finally navigate with confidence.
Index funds, mutual funds, hedge funds, ETFs. They sound like they belong in the same investing toolbox. But choose the wrong one, and you could be quietly throwing away years of growth. Or worse, watch your savings leak away, a few dollars at a time, year after year. Each fund has its own purpose, its own risk, and its own cost. And here's the twist most people never see coming. The one that looks safest could be the one silently costing you the most. By the end of this video, you'll know how each fund works, how it makes money, and which one actually fits your goals.
Here's why this matters. More than half of Americans own stocks, mostly through retirement accounts. And most of that money is sitting inside investment funds. But according to the SEC, the majority of investors can't explain how their fund works, or even what they're paying in fees. That ignorance comes at a cost. Higher expenses, lower returns, and more risk than they realize. And it's not just beginners. Even legends like Warren Buffett, Ray Dalio, and Jack Bogle spent decades debating which fund structure truly builds wealth over time. So before we dive into the differences, let's understand why this conversation matters more than ever.
With the basics. What exactly is a fund? A fund is a pool of money collected from many investors, managed together and invested across assets like stocks, bonds, or real estate. You buy a slice of that pool, and in return, the fund handles everything else. It's diversification made simple. But not all funds are managed the same way, and those differences change everything. Index funds. An index fund doesn't try to beat the market. It copies it. It follows a fixed list, an index, like the S&P 500, NASDAQ, or Dow Jones. No one's guessing. No one's trading daily. It simply mirrors the index. Because there's no expensive manager, fees are tiny, fractions of a percent. That's why long-term investors love them. Low cost, low stress, and consistent performance. You won't get rich overnight, but you'll likely sleep better over the long run. Mutual funds. Mutual funds look similar, a group of investors pooling money to buy assets. But here's the key difference. They're actively managed. There's a professional manager or a team choosing what to buy or sell. The goal? Beat the market. But those decisions come with a cost. Management fees, trading fees, marketing fees, typically 10 times higher than an index fund. And here's the reality. Most mutual funds fail to outperform the market. You pay more and often get less. Still, some investors choose them because they trust a specific manager or simply because their retirement plan doesn't offer alternatives. Hedge funds. Now, hedge funds, they're a completely different universe. They're private, exclusive, and built for risk. They use leverage, short selling, and derivatives, tools that can multiply profits or losses. They charge the famous 2 and 20, 2% of your assets, plus 20% of any profits. They can deliver massive gains, but when they fail spectacularly. Hedge funds aren't built for the average investor. They're designed for the wealthy, people who can afford to lose big in pursuit of winning bigger. ETFs. Finally, ETFs, exchange-traded funds. Think of them as a modern hybrid between an index fund and a stock. Like index funds, they track an index. But like stocks, you can buy or sell them at any time. That means real-time pricing, flexibility, and extremely low fees. ETFs have exploded in popularity, from $400 billion in 2005 to over $10 trillion today. They combine the diversification of index funds with the liquidity of stocks. For most investors, they're the perfect middle ground, simple for beginners, powerful for professionals.
So now you understand the fundamental mechanics of how various investment funds operate. However, a crucial question remains for every investor. Which specific fund is the right choice for your financial future? Making an incorrect selection isn't merely a minor oversight. It can silently erode a substantial portion of your investment portfolio. This quiet drain can amount to thousands of dollars over time, impacting your long-term financial goals significantly. The most significant financial pitfall isn't found in high-risk ventures like speculative hedge funds. Instead, the true trap often lies within the investment options that appear to be the safest and most reliable. We are talking about traditional mutual funds, a common choice for many investors seeking security. These funds often present an image of stability, suggesting a secure foundation for your investments. Their marketing and presentation often sound highly professional, instilling a sense of confidence in their management. Consequently, they feel inherently trustworthy, leading many to believe they are making a prudent and secure investment choice. However, beneath this veneer of safety, a different reality often exists. Their consistently high fees and frequent underperformance can gradually diminish your returns year after year. This erosion of wealth is not due to market volatility alone, but rather the inherent structure of these funds. It's the hidden costs, often overlooked, that compound negatively against your investments over time. Every single dollar that is lost to these unnecessary fees is a dollar that is prevented from growing and contributing to your financial future. Over several decades, this seemingly small difference can have monumental consequences. It can be the deciding factor between achieving a comfortable retirement, free from financial worries, or facing the harsh reality of not being able to retire at all. Understanding these hidden traps is crucial for every investor to make informed decisions and secure their financial well-being. If you are seeking investments that offer low cost, minimal stress, and consistent long-term growth, then index funds and exchange-traded funds or ETFs, are truly hard to beat. However, if you specifically believe in a particular manager's unique strategy and are willing to accept potentially higher fees, then traditional mutual funds can certainly have their place within your portfolio. For those who are already wealthy, highly experienced in the markets, and genuinely thrive on taking calculated risks, then hedge funds might indeed be your preferred arena for investment. Yet, for the vast majority of investors, the most intelligent and effective path to financial success is often also the simplest one to follow. Always remember to diversify your investments across various assets. Make a conscious effort to keep your investment costs as low as possible. And crucially, stay consistent with your investment strategy over time. Because, in the long run, the impact of fees often matters significantly more than short-term performance fluctuations. A well-defined structure consistently beats speculative gambles. And unwavering patience will always triumph over impulsive, fear-driven decisions. Actively avoiding that slow, insidious leak of excessive costs and poor decisions can truly be the pivotal difference between achieving financial freedom and enduring frustrating setbacks. It's the crucial distinction between comfortably retiring with peace of mind or facing the harsh reality of not retiring at all. If this video has helped you cut through the financial noise and gain clarity, please hit the like button so more people can discover it. And be sure to subscribe for our next deep dive, where we will meticulously build a real portfolio using these very funds step by step. Because truly understanding how your money operates and grows is undeniably the essential first step to effectively making it work for your future.